Folks, joining me now, Great Hill Capital Chairman Thomas Hayes. Let's pick up on that, Thomas. What camp are you in? You know, the soft landing, hard landing, no landing, recession, no recession?
I think we're soft to no landing. And if you look at GDP now, for instance, Atlanta GDP now is at plus 5.1%. Earnings estimates were too low again, negative 30 basis points. Now we're plus 30 basis points.
Is that good or bad, though? Because a lot of folks, I mean, some of the usual suspects, the Mike Wilsons of the world, are saying there's just too much excitement, too much enthusiasm over these earnings.
I'm still waiting for that triple break putt call from last year. It never happened. But I got to tell you, I would say, look, earnings have been beating by 300 basis points for the last few quarters. So I think people are flat-footed going into this earnings season. I think there's a lot of cash. I think performance is still up for the year. Managers will have to chase into year-end. So we're looking for some things that have been left behind. Certainly the Magnificent Seven will do fine into year-end, but there have been a lot of stuff that have sold off from this bond route. And we think the bond route is pretty much near its end. I think October 6th may have been the bottom. You look at positioning from large traders and hedge funds. They're the most short bonds since they've been since October 2018. That was right before a really big rally. You look at bonds over the last 35 years, 2 standard deviations oversold. So if that route is over and yields have peaked or are close to peaking, then you want to look at those groups, equity groups that have been hit by it.
Right.
Utilities started to pop last week. REIT started to pop last week. But the big one has been staples because everyone's afraid of this GLP-1 overhype. And I'm just waiting for all these insurers to pay $14,000 to $16,000 a year so I can get into a size 6.
Yeah, you're talking about, of course, the Ozempic factor.
Yeah,
and it's weighed on everything. Hospital stocks have gotten hit because of it. Food stocks have gotten hit because of it. And the notion that everyone in this country is going to have access to this very expensive drug, is really amazing. So you say because they have gotten hit in part because of that.
Yep.
Are you concerned too with the staples? Like maybe they don't have the pricing power anymore? Because initially this was the hot trade.
Yeah.
Buy staples. You know, you can always mark up a box of cereal extra 20 cents. All of a sudden you couldn't mark up a box of cereal extra 20 cents.
Yeah, I think they're starting to lose the pricing power, but their costs are actually coming down.
Good
so.
point.
You had the bond route. They sold off on rates, which they tend to trade with rates. But you also had the GLP-1. And on that basis, we think there's some opportunities in those food stocks. You know, one of the ones we're looking at, Charles, Kimberly-Clark, tissues and diapers. This sold off because of GLP-1?
Right.
Come on. No, it sold off because of rates.
Yeah.
This is a compounder. This business has compounded capital at 20% per year for the last decade. When you can buy it on sale, you want to do that.
All right, less than a minute to go.
Yeah.
Now, you're saying that 40.89, 48.8, 40.89 could be the top. But I did read somewhere, like, if we do go through there, because you referenced the last 35 years, but you could reference the 35 years before that, the bear market, the secular bear market that lasted 40 years. If we go through that, you suggested maybe we would use we would implement some sort of yield control?
Yeah, yield curve control. You've heard Yellen talk about it in the past. You've heard Powell talk about it in the past. We actually used it in the United States from 1942 to 1947 very effectively. That was the last time we had debt to GDP of 120%. We brought it down to 63% by 1956. So we can allow inflation to run a little hot, 3-4%, maybe use yield curve control. It doesn't cost the same as QE. We're not going to have to do massive amounts. We're going to say this is where the peak in rates is going to be. And every time it tips above that, they buy a little bit. And once the market knows that, they stop trying to press them.
So we just throw the free markets out the window.
Well, you know,
that's rhetorical.
The Japanese did pretty well with it since 2016.
They did okay. There's some other issues, but
Fair,
Thomas,
fair.
good stuff.
Hey,
Appreciate
thanks for having me.
All right, folks, we'll be right back.